You're listening to the Shaughnessy Group podcast, insights on buying, selling, and growing Canadian businesses in the lower middle market. Let's begin.
Usually when we talk about a massive financial windfall, there's this kind of underlying expectation of finality, like winning the lottery.
Oh, right. You match the numbers and you're done.
Exactly. They hand you that giant, oversized novelty check, the cameras flash, and you just walk away into the sunset. The story just ends right there.
Yeah, the transaction is complete. It's clean, simple, and totally binary. You either have the money in your bank account or you don't.
But, when you step into the complex world of private business sales, suddenly that giant novelty check comes with, like, a thick stack of sticky notes attached to the back of it.
A very thick stack.
Right. So imagine this scenario for a second. You're listening to this, and you've poured your blood, sweat, and tears into building a successful Canadian business. You've endured the sleepless nights, the market downturn.
The hiring crises, all of it.
All of it. And you finally reached the finish line. You sell the company for, say, somewhere between $5 to $50 million.
Which, that is an incredibly life-changing event. It's this massive validation of years, sometimes decades, of relentless work.
Absolutely. A massive win. But then the buyer slides the final contract across the boardroom table, and there is a major catch.
Always a catch.
Always. They offer you a lump sum today, let's say 60% of the purchase price, but they promise a huge secondary bonus later. But that bonus only materializes if the business hits certain aggressive financial targets over the next 2 or 3 years.
Right. And this arrangement is exactly what the industry calls an earnout.
Exactly. And our mission for this deep dive today is to unpack the really specific, highly hidden dangers of relying on what are called EBITDA earnouts. We're using a really comprehensive guide from the Shaughnessy Group to walk us through this.
And honestly, the stakes for anyone navigating this mid-market space right now are incredibly high. Like back in 2021, 33% of all Canadian private M&A deals...
Wait, really? A third of them?
Yeah, a full third of all deals included earnouts. Yet, the traditional legal and structural protections that used to keep sellers safe in these transactions, they're kind of quietly fading away in the Canadian market.
So we really need to figure out how to protect that hard-earned money. So let's start with the basics. Even though, most people know EBITDA is essentially a standard measure of a company's raw operating profit.
Right. Earnings before interest, taxes, depreciation, and amortization.
Exactly. The true danger here lies in how easily that specific number can be manipulated after the sale. I like to think of it, it's like selling your beloved car to a stranger, right? But agreeing that your final payment depends entirely on the gas mileage they manage to get after they start driving it.
That is honestly the perfect way to visualize it, because the moment you hand over the keys and the title, you aren't the one behind the wheel anymore. You've completely surrendered control of the machine, but your financial future is still entirely tethered to its performance.
So if I'm sitting at that negotiating table, my very first instinct is to just ask the buyer, like, why do we have to base this complex bonus on EBITDA in the first place? Why not just base my earnout on pure top-line revenue?
Well, because revenue is objective.
Exactly. The money either came in the front door or it didn't. You can't fake that.
You're hitting on a really fundamental tension in these negotiations. From your perspective as a seller, revenue is vastly superior because it's incredibly difficult to hide or manipulate.
Makes sense.
But buyers, well, they strongly prefer and often insist on EBITDA. They prefer it because it reflects the actual bottom line. It measures the cash the business is legitimately generating from its core operations, after the expenses are paid.
Which, that sounds perfectly reasonable in theory. The buyer wants to ensure they are paying for a genuinely profitable machine, not just a company with high vanity metrics, but bloated expenses.
In theory, yes, it makes perfect sense. But the fascinating and frankly terrifying reality for sellers is the sheer malleability of EBITDA. Well, once the deal officially closes, the buyer gains this immense, perfectly legitimate power to severely reduce that EBITDA number through their operational choices.
Okay, let's get into the mechanics of that.
Yep.
Because if we are using standard accounting rules, EBITDA shouldn't just be something you can shrink on a whim without, committing outright fraud. How do they actually manipulate it legally?
Think about how these acquisitions are typically funded. A buyer, especially like a private equity firm, might take out a massive commercial loan just to purchase your company.
Right, they use leverage.
Exactly. And once they officially own it, they can load your former business with that exact acquisition debt. Suddenly, the interest costs associated with buying you out are eating into the company's operating profit.
Oh, wow. That's sneaky.
It is. Or consider a strategic buyer, like a much larger corporation with multiple existing divisions.
Right. They have a whole established corporate infrastructure.
Yeah.
A massive headquarters, huge HR departments, all of that.
Exactly. And post-sale, they can just decide to allocate a significant chunk of their existing corporate overhead onto your old business's books.
You're kidding.
No, it happens all the time. Suddenly, your previously lean, agile operation is paying for a portion of the parent company's massive HR department, their expensive legal retainers, and their executive compensation packages.
So my formerly profitable business is essentially subsidizing their corporate bloat. And because that drives down my specific division's profit margin, my earnout just evaporates.
That is a very common mechanism. And they can also fundamentally change the business strategy. They can front-load heavy research and development costs or launch massive, really expensive marketing campaigns.
Or buy a bunch of new equipment.
Exactly. Undertake huge capital expenditures to upgrade the facilities. They might even decide to transfer your most reliable, profitable client contracts over to a different, underperforming business unit within their broader portfolio.
Wait, hold on. Let me run a hypothetical scenario by you. If I sell my specialized software company, the new owner could come in on day one, triple the marketing budget, and maybe hire themselves or their board members as like strategic consultants with massive retainer fees.
They absolutely could.
And they could just intentionally wipe out the profit margin for 2 years, knowing full well it ensures they don't have to write me that second earnout check.
Yes. And the truly chilling part for a seller is that these buyers rarely look like mustache-twirling villains in a courtroom when they do it.
How is that not villainous?
Because they can effortlessly justify almost all of those actions as entirely reasonable business decisions.
I'm sorry, how is intentionally tanking the profit margin of a newly acquired company a reasonable decision?
Because, tripling a marketing budget or overhauling the tech stack might actually be a brilliant necessary strategy for the long-term health and scale of the company.
I see.
Right. It might reap massive dividends 5, 7, or 10 years down the line. But it completely destroys the EBITDA now during your tiny 12 to 24-month earnout window.
That is infuriating. There have to be a legal mechanism to prevent that. Like, if I sign a multi-million-dollar contract with you, there's an implied understanding that you won't actively sabotage the exact metric my payout depends on. Surely Canadian courts protect sellers from that kind of blatant bad faith.
You'd certainly hope so. But this brings us to a major reality check regarding the legal landscape here in Canada. The rules of the game were clarified and arguably complicated by a landmark 2014 Supreme Court of Canada case called Boston versus Earnout.
Okay, I'm assuming the Supreme Court didn't just give buyers a blank check to ruin sellers. Did they side with the idea of implied protection?
Well, they established a middle ground that actually leaves a lot of sellers pretty exposed. The court ruled that good faith is indeed an organizing principle in all Canadian contracts. They created a strict duty of honest performance.
Which means what, practically speaking, for you and me if we're selling a business?
Practically, it means the buyer cannot actively lie to you. They can't deceive you about their operations, they can't forge documents, and they certainly cannot keep a second set of books to fraudulently hide profits.
Okay, so outright fraud is illegal. That is a remarkably low bar.
It's a very low bar. Because we have to look really closely at what that Supreme Court ruling doesn't mean. It absolutely does not mean the buyer has any fiduciary duty to maximize your earnout.
Wow.
Yeah, they are not legally required to put your financial interests above their own strategic goals.
So they can make those reasonable business decisions, like overhauling the software, changing suppliers, or pivoting the entire sales strategy, even if they know with absolute certainty that it will demolish my payout.
Precisely. As long as they aren't deliberately and maliciously frustrating the earnout through pure deceit, they are generally protected by the law.
So going back to our earlier car analogy, is the difference between the buyer walking out and maliciously slashing the tires of the car I just sold them.
Which is bad faith and illegal.
Right, versus them just deciding to drive the car strictly in first gear on the highway because they genuinely feel it's better for the engine long term.
That is the perfect distinction. Driving in first gear isn't illegal, even if it completely ruins the gas mileage metric your payment depends on.
That's wild.
Now, there is one slight regional nuance worth mentioning for Canadian businesses. If your contract is operating under Quebec's civil code, there is a more explicit written duty of good faith and contract performance that offers slightly more protection.
Good to know for our listeners in Quebec.
Yes. But in the common law provinces, which covers the vast majority of Canada, the lines are much blurrier, even in a post-Bazin world.
So the major takeaway here is crystal clear. You absolutely cannot rely on the courts or some vague gentleman's agreement of implied good faith to ensure you get paid.
Not at all.
If the law won't protect you by default, you have to build bulletproof armor directly into your legal contract before you sign it.
Exactly. Handshakes do not pay the bills in M&A. You need explicit, detailed, structural protections. And the Shaughnessy Group Guide outlines 5 critical layers of armor every Canadian seller must negotiate.
Well, let's build that armor right now. If I know the courts won't stop a buyer from fundamentally changing the business to ruin my earnout, my first priority has to be legally restricting their operational behavior.
And that is layer number 1, the ordinary course of business covenant. You must demand language in the share purchase agreement that legally requires the buyer to operate the business the exact same way you did.
Meaning they can't just pivot the whole company to a brand new experimental market on day 2.
Right. Specifically, you want a binding clause stating they must run the business consistent with past practice for the 12 months prior to closing.
So you're legally locking in the operational status quo.
Yes. There can be no changing the core business model, no firing your most reliable, cost-effective suppliers, and absolutely no transferring revenues to other divisions without your explicit written consent.
Okay, so I've successfully locked down the operations. But we just talked about how easily they can manipulate the accounting itself by loading the business with debt or corporate overhead. What's stopping them from just using aggressive accounting tactics to hide the money, even if the operations stay the same?
Well, that brings us to your second layer of armor, defining the math. As we discussed, EBITDA is incredibly slippery.
Very.
You cannot just write the word EBITDA in the contract and assume the buyer's accountants and your accountants will magically agree on how it's calculated. You need crystal clear, exhaustive definitions of exactly what counts toward your target, and more importantly, what must be excluded.
So what are the biggest red flags I should be demanding they exclude from the calculation?
You must legally exclude any post-merger integration costs. You exclude the interest on their new acquisition debt.
Right, we mentioned that one.
Yeah. You also exclude any overhead allocations or management fees from their parent company, and you exclude any extraordinary non-recurring expenses that just wouldn't have happened if you were still in charge.
I read a phenomenal tip in the source material about this exact issue. They argue that you shouldn't just rely on abstract accounting hierarchies, like whether you're using standard GAAP or IFRS rules.
Oh, the spreadsheet tip.
Yes, they suggest literally building a mathematical model, putting it in a spreadsheet, and attaching it as an exhibit in the legal contract itself.
It is arguably the most effective strategy you can deploy. If you leave the calculation up to general accounting principles, you leave a massive exploitable gray area for interpretation.
Makes sense.
By attaching a spreadsheet and saying, look, here is a mathematical model showing exactly how the calculation must flow under these specific financial scenarios, you make the standard ironclad. Numbers don't leave room for creative interpretation.
I love that. But here is my next major concern. Even with the operations legally locked down and the math strictly defined in a spreadsheet, I'm no longer in the building.
Right, you're out.
I don't have the corner office anymore. So how do I actually stop them from making a terrible, earnout-destroying decision in real time?
By refusing to leave the building entirely.
What do you mean?
This is layer 3, governance rights. Just because you sold the majority of the business doesn't mean you have to completely surrender all oversight. You need to negotiate a way to stay in the room where the decisions happen.
Like demanding to retain a seat on the board of directors during the earnout period.
Exactly. You can retain a board seat. Or you can negotiate strict unanimous consent requirements for major structural decisions.
Thanks for listening. If you're finding these episodes helpful as you think through your exit, there's another resource we want to mention. We've put everything we know about selling a Canadian business into a book, Selling Your Canadian Business, a step-by-step guide to maximizing value and securing your legacy. It covers the full journey, from preparing your company for sale, to navigating due diligence, to negotiating deal terms that protect what you've built. Think of it as a companion to this podcast, something you can reference, highlight, and come back to as you move through the process. It's available now on Amazon. Visit sellingyourcanadianbusiness.com or check the link in the show notes. Thanks again for being here. Now back to the episode.
So I essentially give myself a veto pen over big capital expenditures or new acquisitions. But realistically, will a buyer who just paid $20 million for my company ever agree to let me veto their executive decisions? It seems like a massive point of friction.
It is a very difficult negotiation, and buyers will fight it aggressively. They want a clean break.
Naturally.
If they flat out refuse to give you a veto, your absolute baseline fallback is strict information rights. At the bare minimum, you must have a contractual right to see the monthly financial statements, review the operational metrics, and have full access to the books.
So you aren't just completely in the dark.
Exactly. You cannot fly blind for 2 years and just sit at home hoping a check arrives in the mail.
That makes total sense.
Yeah.
Now, what happens in a worst-case catastrophic scenario? Let's say a year into my earnout period. The buyer mismanages their broader portfolio and goes bankrupt.
It happens.
Or, alternatively, they get an incredible offer and just flip the business to a massive global conglomerate. My earnout agreement was with them, not some new conglomerate.
This is where Layer 4 becomes critical. Acceleration triggers. Sometimes the absolute best defense against uncertainty is forcing an immediate full payment.
Oh, I see.
You build clauses that dictate if certain specific extreme events occur, your entire potential earnout, like 100% of it, becomes due and payable immediately.
So an acceleration trigger forces a payout. I imagine that kicks in for major structural changes, like if they sell the business to a third party or undergo a change of control.
Yes, if they sell off 25% or more of the assets or undergo a change of control, that should trigger acceleration.
What about the bankruptcy scenario?
It should also trigger if they become insolvent or file for bankruptcy, or if they fire you or your key management team without cause, or, crucially, if they materially breach any of those operational covenants we just locked down in Layer 1.
It basically acts as an automatic, severe financial penalty for breaking the rules of the earnout.
Precisely. Now again, the market reality is that buyers fiercely resist acceleration clauses. Accelerating payment upon a change of control isn't entirely standard across the board in Canada, but if you have leverage, if it's a strong seller's market or your specific technology is highly sought after, you must push for it.
Let me push back on the bankruptcy scenario, though. If the buyer is insolvent, an acceleration trigger just means they legally owe me money immediately.
Right.
It doesn't mean they actually have the cash to pay me. An earnout is completely useless if their bank account is empty when the invoice comes due.
Which brings us to the fifth and final piece of your armor, financial security. You have to ensure the capital actually exists and is protected from the buyer's other creditors.
How do I do that? Do I force them to set the money aside in a vault?
Essentially, yes. The most secure option is an escrow account, where a significant portion of the purchase price is held by a neutral third-party bank until the earnout period concludes.
That sounds safe.
Very. But if the buyer outright refuses escrow because they need the liquidity, you can demand personal guarantees from the buyer's principals.
Oh.
Or if the buyer is just a subsidiary shell company created specifically for this acquisition, you must demand a parent guarantee from the main well-capitalized corporation. You can even negotiate a security interest, which is a literal registered charge or lien on the business assets themselves.
Okay, so we have built a remarkably robust fortress. We have the ordinary course of business covenant, the mathematically defined spreadsheet, governance and information rights, acceleration triggers, and financial security guarantees.
It's a solid defense.
But the Shaughnessy Group Guide points out some incredibly sneaky legal fine print that can still ruin you, even with all that armor. I want to talk about what they call the indemnity trap.
Yes. The indemnity trap is a classic, deeply frustrating post-close nightmare. Imagine you're 6 months into your earnout period. The buyer discovers, or, conveniently claims to discover, a liability issue from before the sale.
Like what?
Maybe it's a minor pending lawsuit from a former disgruntled employee or a slight discrepancy in old tax filings. They claim you legally owe them indemnification to cover the cost of this problem.
Okay, so we'd have to sort that out legally, maybe go to court over the employee lawsuit.
You would think so. But instead of pursuing a separate legal claim against you, they just unilaterally decide to withhold your upcoming earnout payment to cover their claim damages.
Wait, they just decide I owe them, act as judge and jury, and use my earnout like their own personal piggy bank to pay themselves back.
Exactly. And the terrifying part is that in Canada, if your share purchase agreement is completely silent on this specific issue, you are left incredibly vulnerable to this kind of unilateral offset.
So how do I shut that down before I sign anything?
You must expressly negotiate a total contractual ban on offset rights. The document needs to explicitly state that they must pay your earnout in full, regardless of any other ongoing disputes.
And if they have an issue?
If they want indemnity for a past issue, they have to pursue it entirely separately. If they won't agree to a total ban, you must aggressively cap their offset rights at something manageable, like 25 or 50% of the earnout payment.
That makes sense.
And you have to stipulate it can only be used for claims that have been finally legally determined by a court, not just conveniently alleged by the buyer.
That is a crucial distinction. Now, when they inevitably try something sneaky, whether it's an unjustified offset or manipulating the EBITDA, how do we actually resolve it? When a dispute arises, my instinct would be to just bring in an independent forensic accountant. It's a financial dispute about EBITDA. Let a numbers person solve it. Is that the standard move?
That instinct is very common among sellers, but relying solely on it is deeply flawed.
Really? Why?
An independent accountant is fantastic if the dispute is a pure objective calculation error, like whether a specific expense was categorized correctly under accounting standards. But earnout disputes are rarely just about the math.
Right. They're about the behavior behind the math. They're about whether the buyer changed the marketing strategy maliciously to tank the profit.
Exactly. They are about whether the buyer acted in good faith or whether they intentionally breached an operating covenant. An accountant has absolutely no jurisdiction, training, or legal authority to adjudicate behavioral breaches or contractual intent.
So what's the alternative?
You need a structured dispute resolution process built directly into the contract that mandates binding arbitration for these specific behavioral conflicts.
So you need a legal arbitrator who can evaluate the conduct of the executives, not just look at the spreadsheet.
Precisely. And speaking of evaluating conduct, there is one specific, highly negotiated phrase in the contract that dictates everything. It's called the effort standard.
The effort standard.
Yeah. This single clause defines exactly how hard the buyer is legally obligated to try to hit your earnout targets.
I'm guessing there is a massive spectrum of what effort means in a legal context.
A huge spectrum. On the worst possible, most buyer-favorable end, the contract will state that the buyer operates the business in its sole discretion.
Which basically means we will do whatever we want, whenever we want, and your earnout is not our problem.
Yes, it is a legal license to ignore your earnout entirely. Moving slightly up the spectrum, you have commercially reasonable efforts, which sounds nice, but is highly subjective and heavily litigated.
And on the other end?
On the strong, seller-favorable end, you want language demanding best efforts or reasonable best efforts to actively and intentionally achieve the earnout targets.
But let me play devil's advocate here. If I'm a buyer, I am never handing out a best efforts clause. I am not going to legally obligate myself to prioritize your bonus over my own strategic plans for the company I just bought. Are buyers actually agreeing to this?
If we look at the broader market data, the statistics are genuinely grim for sellers. In 2022, only 23% of U.S. transactions required running the business strictly by past practices.
Oh, wow.
And a shocking 1% of deals included covenants where the buyer legally agreed to actively maximize the earnout.
1%. So 99% of sellers are completely exposed on that front.
Exactly. Canadian practice tracks very closely with those numbers. You have to fight tooth and nail for this language, and you will almost certainly have to compromise.
Which makes the practical playbook from the Shaughnessy Group so vital. Let's dig into their golden rules for navigating this space, specifically for businesses in that mid-market $5 to $50 million range. Rule 1 seems to be the most obvious. Avoid the problem entirely by minimizing your earnout exposure from the start.
Yes. The earnout should be the icing on the cake, not the cake itself. You should aim to keep it under 20 to 25% of the total deal value.
That makes sense.
If a buyer wants 50% of the purchase price tied up in an earnout, you are taking on far too much systemic risk.
Rule 2 is fascinating, but I need you to explain how to actually pull it off. The guide suggests swapping EBITDA for revenue. Now, I understand why you would want that revenue so much harder to manipulate with accounting tricks. But if I'm the buyer, I don't care about your revenue if the business isn't profitable. How do you convince a cautious buyer to base a massive earnout on top-line revenue?
It requires a very strategic conversation about alignment during the negotiation. You argue that during a post-merger transition period, the buyer is going to be messing with the operations anyway. They'll be integrating software systems, changing management structures, altering workflows.
You're right.
It is deeply unfair to judge the business's core performance based on a bottom line that is currently under construction. Revenue, however, proves the market still desperately wants the product.
I see.
And if the buyer flat out refuses revenue, a fantastic compromise is gross margin.
Gross margin. So top-line revenue minus the direct cost of goods sold, but calculated before all the corporate overhead, HR salaries, and administrative expenses get factored in.
Exactly. It completely removes the buyer's ability to manipulate the final number through excessive bloated overhead allocations.
That is incredibly smart. Rule 3 is using a sliding scale, which I absolutely love.
Yeah.
Instead of a brutal all-or-nothing cliff, where missing a $10 million EBITDA target by one single dollar means you lose a $2 million bonus, you make the payout graduated.
You negotiate a floor and a ceiling. For example, you get $1 million if the business hits $9 million in EBITDA, scaling up proportionally dollar for dollar to a maximum of $2 million at the $10 million mark.
It removes that intense, toxic pressure cooker environment. Because if a buyer knows they're going to miss an all-or-nothing target by a few $1,000s, they're actually incentivized to just tank the whole year, write off a bunch of expenses, and pay you zero.
Exactly. A sliding scale keeps them honest because every dollar of profit still triggers a partial payment. It really aligns incentives.
Right. What's Rule 4?
Rule 4 is about duration. Keep the earnout period short. 1 to 2 years maximum. The longer the earnout stretches on, the more time there is for macroeconomic shifts, new management teams, and creative accounting to ruin your day.
And there's a specific tax implication here in Canada too, right?
Yes, the Canada Revenue Agency generally requires earnouts to conclude within a 5-year window to qualify for certain favorable tax treatments, like the cost recovery method. But practically speaking, for your own sanity and financial security, you want it over much sooner than that.
And the final rule: get your team in place early. You cannot use your standard everyday corporate lawyer who helped you sign your commercial office lease 5 years ago. You need a highly specialized M&A lawyer, a seasoned tax advisor, and an accountant who can actually stress test and model these specific earnout scenarios before you sign a single document.
You truly do, because the consequences of getting this wrong are severe, and they are very real. To bring this all home, let's look at a cautionary tale from the courts. The heavily cited case of Main Market Partners versus Olon Recerca Bioscience.
Break this timeline down for us. What actually went wrong here?
So a business was sold with a very significant earnout attached, but almost immediately after closing, the buyer started acting highly strategically. They began steering incredibly lucrative, newly signed contracts away from the newly acquired company, funneling that business directly to their own parent company.
Wow. Just openly poaching the revenue right out of the gate so it wouldn't count toward the target.
It gets worse. They intentionally delayed paying customer invoices so that incoming revenue wouldn't officially hit the books in time for the final earnout calculation.
Unbelievable.
They also incurred totally unreasonable, massive strategic costs, and they actively obscured their detailed expense reporting from the seller so they couldn't see what was happening.
So they systematically starved the acquired company on paper. Let me guess. The business miraculously missed its EBITDA target at the end of the year.
Exactly. The target was missed, and the buyer confidently declared that no earnout was owed. The seller had no choice but to file a massive, incredibly drawn-out lawsuit just to get a court to examine these blatantly bad faith actions.
And that is the ultimate lesson here. Even if you are totally in the right, and even if the buyer's behavior is overtly egregious, having to litigate an earnout is a catastrophic nightmare. You are bleeding money on expensive litigators, spending years in court, and destroying your peace of mind just to fight for the money you already rightfully earned.
Prevention is the only actual cure. Do not ever rely on the threat of litigation to keep a buyer honest. Rely entirely on the ironclad structural constraints of your contract.
Okay, to summarize this entire complex landscape for you, earnouts are an inevitable reality of the modern mid-market transaction. They serve a very real purpose. They bridge the valuation gap between what you believe your life's work is worth and what a cautious buyer is willing to guarantee today.
But they are incredibly delicate, highly volatile instruments that are easily weaponized against you.
Exactly. You cannot simply accept the first draft of a share purchase agreement because you're excited about the upfront cash.
Yeah.
Your business took years, maybe decades to build. Do not leave your hard-earned money on the table right at the finish line because you didn't define the math.
The time to negotiate your armor is before you hand over the keys. Once you do, you are permanently in the passenger seat.
We want to send a huge thank you to the Shaughnessy Group for providing these essential, eye-opening insights. For more incredible resources on navigating the complex sale of your business, please visit their website at www.shaughnessy.group. You can also check out the Amazon link for their book, https://www.amazon.cad.pb0yafxwjvxq.
And to close things out, I want to leave you with one final provocative thought to ponder. It brings us right back to that illusion of control we started with. If an earnout forces you to stay financially tethered to the company you just sold and leaves your ultimate payout entirely subject to the strategic whims, market pivots, and aggressive accounting practices of the new owners, are you truly selling your business, or are you just taking on a new, much more complicated boss?
This podcast is for informational purposes only and is not professional advice. Consult qualified advisors for your specific situation.